So to sum up, we have a client. We passed the process of understanding the how much money they have. We passed the process of understanding the how much money they can borrow and for how long, according to their age. And we actually understood and we qualified them as with a foreign income. What will be the rates for that?
So there are many different products in Israel, like we mentioned earlier. And in Israel, you can mix and match different products within certain criteria. A foreign resident has, call it an advantage, that they can take the entire loan in a variable rate. And generally speaking, variable rates are lower than fixed rates. So based on today is, we're in November 2020, variable rates can be as low as, let's say, roughly 2.5%. However, an Israeli resident would have to take at least a third of the loan on a completely fixed rate, and they can take maximum of a third on a variable rate. So there are people who like fixed rates, and they'll just want to take the entire loan in a fixed rate, and that's fine. But there are people who are looking to get the lowest effective rate, and therefore they would mix and match different products that would suit them. Some products have a potential for a prepayment penalty. Fixed rates, if when you want to repay and the rates in the market are lower, then there's a penalty. If the rates are higher, there's no penalty. And some people don't necessarily want to be locked into a product because they know they want to be repaying the loan earlier than the full term. They would take a longer term to lower their payment. And variable rates have no penalty. So that's another consideration to take into account.
Going back to the rates, understanding the different rates and different variables and details, how would it be different to consider the different rates models in the mindset of an investor?
So generally speaking, most people who are looking to invest in a property in Israel, very often they say they're just happy that the mortgage will be covered by the rental income. So they know the projected rental income, and they want to structure the mortgage that the mortgage payment will basically cover, at least be covered by the rental income.
And this is one of the questions you ask them: what's the purpose of your purchase?
Of course.
So you would find out with the real estate agent that you work with, what's the income from rent, and what would it be if it's someone who's investing to resell as a flip? What will be the projected resale? And basically the different plans for different types of people who purchase.
Most definitely, because when you're taking out a loan, you want to know if it's going to be long-term debt or short-term debt. And obviously that will help you structure it accordingly to take away any major risks. Another important point, if I may, is that there are both shekel and dollar products available in Israel. So an American who wants to not have the currency risk of borrowing shekels can borrow in dollars. A European, for argument's sake, can borrow in euro. Somebody from the UK, for argument's sake, can borrow in pounds. And very often people would like to borrow in the currency that they're earning so they don't have the currency risk on when they have to repay their mortgage. On the other hand, people want to take out the debt in the currency that the asset is held. So if the asset is held in shekels, people will argue that I want to take out the debt in shekels. So there are different possibilities, obviously within the criteria.